the difference between normal private equity investing and impact investing in private equity is that before you invest, you have clear environmental and social objectives to which you allocate capital in addition to financial returns. So that is true not only for investing in private equity, but also in all other asset classes when it comes to making impact investments. As investors, if you want to make an impact with your capital, it may be good to first of all say that any investment will have an impact, positive or negative. But the difference specifically for impact investments is that you yourself in advance have an intention to achieve specific impact. So for example, if you care about climate change or circularity or water savings or food transition, so you define those themes in advance, and then you select investments that meet not only your financial return, but also contribute to that specific environmental or social outcomes. And that doesn't have to be the case for traditional private equity. There you allocate on more financial criteria without necessarily considering broader environmental or social outcomes. So the value creation is, I would say it's not that different, but it's just more focusing on broader spectrum of criteria. So for example, the normal private equity, you want to grow and scale the business. And if you do impact investments, that's also the same. You want to your business obviously to be successful. You want it to generate returns, but you also want to scale the impact. And then you're looking holistically at the whole process. How do you make sure that you build solid foundation, good corporate governance, set up your team. So the process is important, and that you could say that is more sort of your ESG or sustainable approach, that you have good policies, systems, checks and balances for the companies. And then on the impact side, that you look at, okay, what is actually the product or the service that our company doing? How is it helping customers? Is it saving emissions, or is it enabling our customers to become more efficient? So I think that in the normal private equity, you also want to have robust, solid businesses, but maybe you have less attention and focus to the, let's say, positive social or environmental outcomes of their products and services. Whereas if you do impact investment, this also becomes a big part of that, and you are specifically focusing on creating additional social or environmental value for your customers. The impact funds, they often have a certain duration as well as normal funds. So normally it's a 10+2 structure. You can also have open-end impact funds. So I wouldn't necessarily say that they are involved for longer, but they may be involved also differently. So they are involved in more holistic value creation, impact measurement, setting impact targets and objectives, helping companies to execute on those. Yeah, so impact investments, they can be on the whole spectrum. So what we're talking here today are impact investments that target market rate financial returns. So you have a return and impact objective. And there you look at also financial metrics, like with any other fund or company that you invest in, that you want to make sure that it meets those. But in addition to that, you also have certain environmental or social objectives that you have set in the beginning for the company, depending on your own goals or whatever the company is trying to do. So for example, if you care about climate change and you want to invest in technologies that mitigate climate or focus on adaptation, You may set metrics such as emissions avoided, or waste avoided, or linear resource use avoided for your portfolio. And then you, in some cases, you may even set targets for your funds or investments, and then success is then measured. Okay, what was actually achieved versus those objectives, or in terms of solving that part of the problem. So it's a dual measurement of return plus impact metrics. Impact investments can be successful if you have achieved both the returns that you were aiming for, but also specific social or environmental outcomes. So for example, if you helped the underserved communities that you were targeting, if you reduced certain emissions or waste or whatever you were aiming for, and if you also haven't caused other harm, because that's often the case. Maybe you're helping some people, but you may be harming something else. So I think so it's not easy, especially if you look at the whole picture. So I would say it's a successful investment if it made money, if it scaled, and if it was able to deliver on some of those promises and outcomes without harming others.